brought to you by Growth Dragons. It is a China-focused newsletter where I, Alvin, will be sharing with you on a regular basis what's going on in China. Having understand both the West and the Eastern culture, I'll be in a better position to give you the valuable insights that you might be looking for when you invest in China. So do subscribe to growthdragons.substack.com. That's where you can receive my regular insights about China. Hope to see you there and enjoy the rest of the video. Hi there, this is Alvin from Dr. Wealth. So in one of the earlier videos in 2024, I was making certain prediction for the financial markets this year. And one of the predictions that I have given was that China stocks look set to recover, or more specifically, the MSCI China is likely to deliver a positive return in 2024. So far now into March, end of March, and things seems to be going that way. And let me give you an update about what's going on and how can we look at the China market going forward, especially for some of you who have China stocks or intending to invest in some of the rebound that may be happening in the market as well. So the MSCI China has been on negative return, has delivered negative return in the past 3 years consecutively. So it's one of the signs that I thought that the market shouldn't be able to go even lower in 2024. And what has changed so far was the China Premier Li Qiang, who came out in January to say that the stock market in China needs to be saved. And I think this is a very significant turning point. Why? Because for the longest time, the Chinese government, or at least the current administration, do not really pay a lot of emphasis to the stock market. They care more about the economic growth, right, as well as the strength of renminbi. They will rank higher priority than how the stock market is doing. But it appears that that's not enough, because I think their belief initially was that as long as China delivers economic growth, foreign investors will keep on investing in China. But that's not the case, because in 2023, even though China delivered 5.2% GDP growth, which has exceeded the target of 5% that year, despite that, the stock market continued to slide. And renminbi has to be propped up in order for it to have that strength against the US dollar. But they realized that it's not enough, right? Despite hitting the target, why is that perception on the China economy is still bad? So that is probably the reason that triggered Premier Li Qiang to say that, okay, we need to also manage the perception. The stock market needs to be up. And that's his message. And in China, it's a very top-down thing. You have the number 2 guy that says that, okay, now stock market is important, right? Everybody down the line will be anxious to make sure that the stock market can hold up. And essentially, that would lead to more buying by the so-called China national team. There'll be quite a number of sovereign wealth fund, including this Huijing, which has contributed in propping up the market by buying into China ETFs. Okay, so and in turn, these ETFs will buy the stocks, right? Because they got more funds under their management, so they need to buy according to what index components are, and hence that pushes up the index as well. So you can see this was taken from Bloomberg, and there was increased buying, especially when the stock prices are down, by the China national team. So that gave that market some boost in terms of the buying, and hence the share price of some of these certain stocks have gone up as well. So we can see the different various index, because in China there are so many different indices to look at, right? It's not like US is quite simple. Dow Jones, S&P, and Nasdaq. You want something that's more tech heavy. Just 3 index, because majority of the US companies are listed in US. But China is not the case, because China have Shanghai Index, Shenzhen Index, Hong Kong Index, and there are also China companies that's listed overseas in US, in Singapore, all over the world. So it is quite hard to really get a gauge how is the China market doing with just one index. So hence, I will go through several index, and then you start to see where the liquidity is actually flowing into. So this is CSI 300 index, which comprises stocks from both Shanghai and Shenzhen stock exchanges. And you can see it's already up year to date, right? As of near the end of March, we are looking at a 4% gain. Okay, not fabulous, but it's nonetheless quite a good, decent rebound from here. But unlike the MSCI China is still down. Okay, although it's almost going to be flat, right? You can see the recovery started in January, and the price index have been going up. And my bet is that likely you'll end this year positive. Right? How positive, I don't know, but it should have a positive return by the end of 2024. Okay, so this MSCI China includes all the Chinese companies listed anywhere in the world, right? So this is the most comprehensive one, but it's still dominated by the big tech like your Alibaba and Tencent, which have not been doing that well. They've hence dragged the index thus far. And this is the Hang Seng Index. This is also another representation to show you that because for Hong Kong, most of the funds are foreign funds. It's not invested by their locals, definitely not mainland China, and hence you can see that it's performing worse than the A shares itself. So based on all this, you can see that even the A50 is also up this year, right? So the sensing that you can get from this is that the recovery is concentrated more in the A shares than any other stocks that's listed outside the mainland China markets. Okay, so if you really want to play the rebound, definitely I think the A shares is worth looking at more than H shares, more than the US ADRs. All right. So that's it. Actually, some of the US ADRs did well, okay, which I'll go through some examples later. But I would say that your chances are higher for A shares because it seems that the national team are propping up the mainland listed ones, which makes sense, right? Because anything that's foreign, there are restrictions how much they can invest into, and if you want to save the market, definitely you save the one that's closer to home, right? And A shares or the mainland markets are the ones that are closer to home, and that is where the buying has been happening, and that is where the support for the stock market is going on in China. So that is one thing that you should take note of. And these are some examples that some of the stocks have did quite well year to date, at least. This is Yiren Digital. It's listed in the US. It's a lending company, right? It's a fintech lending company, and it was very undervalued. So it was one of the stocks that I will talk about 1 or 2 years ago. And year to date, it has done well, up 30%. And this is Huya, which is a game streaming company, a subsidiary of more of an investment associate of Tencent, and it's also up 24% year to date. Next one, Media. This is a mainland A share. It makes it's the largest home appliance company in China, and it's up 17% year to date. So I just want to give you a sense, right, where the price gains are, and you'll be surprised that a lot of all these names are not your the first names that you recall when it comes to China stocks, because most people think of Alibaba, Tencent, or even Ping An, or even like ICBC, Bank of China. Those common names, you realize that they didn't do as well, okay, then compared to some of these second tier names. And I just want to give you that sense that no, there are opportunities, just that maybe you've been looking at the wrong places. Okay, so all these stocks are actually covered in my publication Growth Dragons, right? So if you are interested, do subscribe to it, and you can get some of these ideas along with the others as well. So this is Ajisen China, right? So there's a Ajisen ramen chain store, and I did cover this I think early this year, right? And it's up 14%, because I said that it was really undervalued, right? It was trading below its cash value. It doesn't make sense. It was beaten down that much. Fufeng, this is the largest MSG company in the world, not a very sexy company, right? MSG, okay, the food additive that we consume on a daily basis, is up 10% this year, and it has a very generous dividend yield. A lot of these companies have generous dividend yields. SingPoint, this is an automotive company. They make parts, right? Dashboards, those kind of finishing in car interior. And with the growth in EVs in China, right, they are the beneficiary. Okay, they are like selling the shovels to the gold diggers. I would think that it's a safer play if you want to buy the growth in EV, rather than buying an EV company, right? Buying the suppliers to EV industry is a much better or safer alternative, and it's up 15% year to date. And this is Blue Chemical. It makes chemicals. I don't even know what chemicals, okay, but I do have this stock, and it's up 17% year to date. I also covered this in Growth Dragon. So all these stocks I have actually mentioned in Growth Dragons before, and they have relatively done better than the general market. As you can see, the index is A-shares is up like what, 4%, but a lot of these stocks are up more than 10% year to date. So do look at this Growth Dragons. Is Substack publication, right? Or you can just do a Google search, Growth Dragons. The URL is growthdragon.substacks.com, but I'll keep the link in the description box. You can just easily click on it and subscribe to it. Okay, so if only you are interested in China stocks. So can China stocks really recover from here, right? Is this the bottom and it's safe to buy now? I would think so, right? But before you get carried away, the bull run may not be as sustainable as you may think. Okay, because in the previous video I did say this: China stocks can recover only if this happens. So what is this, right? If some of you recall, I did mention that it's related to foreign fund flows. Okay, so in this recent rebound, this past few months, the rebound is largely driven by the domestic buying, which is by the national team, the China national team. So it's internal buying. It's not driven by foreign funds. But for the longest time, if you take a look at the China equity markets, or even any markets outside of the US, most of the time, the indices go up because US funds are buying them. And we know that US and China are not in the best of friends at this point in time. Hence, you do not expect the US funds to be buying into China stocks anytime soon. And even for the past few months, that has been the case. It has been on a decline since 2023, right? The foreign fund flows. So this is not a good sign because there's just so much buying that you can do by a domestic team. And if you buy it too much, you end up having a significant stake, and that drives down the liquidity of these stocks eventually. So you do need these foreign funds to be trading, to be buying and selling these China stocks in order for the market to have a sustainable bull run. Okay, so that's what I believe, and I don't see that yet. Okay, so I would think that the domestic buying can maybe sustain the bull run or the recovery for this year, 2024, but beyond that, I'm not sure. Okay, for that matter, China stocks may not do well from 2025 onwards again, if the foreign funds don't come back. So I think that's a very critical point. And this is the top 50 managers, fund managers in the world, and you realize that 35 of them are in US, another 14 in Europe, and there's only one in Asia. Top 50, there's only one in Asia, and even that fund is a Japanese fund. Okay, which is also not in very good terms with China. So you can see that China has no top 50 funds. These are generally private funds. We are not talking about the sovereign wealth funds, right? Definitely China's sovereign wealth funds got a lot of money. And of course, they're also trying to attract the Saudi sovereign wealth fund, right, which has also been investing in China. So for China to recover, it cannot do it alone, right? It needs help from external parties, okay? And probably if they can get more Middle East countries to invest in China, that could help further. But I would still think that US funds needs to go back to China stock market in order to float it up again. Okay, so that's a very crucial thing that's not happening yet. So all in all, I believe that China stocks should be able to recover. The worst is over, right? I think the worst was 2022 October. Even in 2023, when the stock in China declined, it didn't go below that 2022 low, right? So it's apparent to me that the worst is over. The next question is just how much can it rebound, how much can it recover, and how sustainable it's going to be. It's highly dependent on whether the fund flows come back to China, right? So that has not happened yet, but the domestic buying should be able to clear 2024 for investors. You should see a better year this year. So hopefully this will give you some idea and sensing about what's going on in China, especially if funds invested there or if trying to invest there. Okay, so hope you find this video useful. Give me a thumbs up, subscribe to the channel, and also subscribe to the Growth Dragons Substack publication, and I'll see you around. Goodbye.